These 4 weekly dividend ETFs have been quietly winning amidst the chaos of the weekly dividend market. Now, I do want to showcase they also have 5 new ones that recently launched and have already paid 1 distribution each. And of course, I'm talking about RecShares. We're going to cover these funds, how they work, and how they differ from the competition, and what's been giving them the edge to outperform. So I hope you guys are excited for this video. There is one massive reason why I think these ETFs are less popular than some of the competitors, which we will get into in just a moment. As always, I consider myself to be an expert on the weekly dividend ETFs. I've been tracking them for over a year now, and I own most of them to this point. So don't forget, if you're interested in weekly dividends, to like the video and to subscribe. The RecShares weekly paying growth and income ETFs. You guys are likely familiar with their initial 4. We have COII on Coinbase, MSII on MSTR, NVII on NVIDIA, and TSII on Tesla. Now, I want to talk about what makes these funds perform well with how they are built, but there is a key component that a lot of people like to overlook, and that is the performance of the underlying. And we'll get more into those details. But they did launch some other ones. They have 5 new ones. They have HOII, the Hood or Robinhood ETF, PLTI, the PLTR ETF. We have CWII, the CRVWV, ETF. We have LLII, the LLY Growth and Income ETF. And this one's funny to me. We have WMTI, the Walmart Growth and Income ETF. And it's really crazy to me because I think RecShares is stepping out of the kind of boundaries that a lot of these weekly dividend ETF issuers have set for themselves based off hype and overall growth, I guess you would say, in the market. And they're leaning more into Walmart, companies like Walmart that are consistent and a bit safer, I would say, than a lot of the heavy tech companies, which I think is also very important if we do end up seeing a bear market, which I'm not trying to predict it. I am just preparing in case we do see it based off the index. So what's different about these funds? Most of what I talk about are simple CC funds. They're covered call ETFs that utilize a strategy of options trading with whether it be holding the underlying, holding a portion of the underlying, or having a fully synthetic position. And what Rex is doing is they kind of split it between growth and income. And there's one reason why this is absolutely amazing. But I do want to showcase first, you have half the portfolio that's going to generate weekly income via their covered call strategy. So similar to how all of the other ones work. And that's amazing. Call options are written on half of the portfolio using short-term out-of-the-money contracts seeking to generate consistent weekly income by capturing elevated volatility. Now, I do want to make one big point on this. Something like Walmart is going to have less implied volatility than something like PLTR or HOOD. So I'm curious how this lower implied volatility fund will do in comparison with both payouts and overall return. And then we have the other side. And this is what's different, right? So we have half the portfolio that is going to remain uncovered, which is allowing for uncapped upside potential. And what I mentioned earlier, this is a huge factor because I've interviewed CEOs of these income funds, and a lot of them talk about the capped upside, and it's really hard to predict that. I believe it was the YieldMax ETF interview I did, and they actually specified that if there's a crazy move on, say, HOII in a day, say it goes up 9%, they can try and shift the strategy with the options, and they may capture 2 to 3% of that run, but they are still capped. And, I mean, it's a micro kind of aggression strategy. They have to be on the ball all the time. Whereas when we look at these, yes, they still have that portion of it where they're writing those options, but you're still going to get half of it uncapped, which is amazing, especially on those days where the market runs like mad. So the other half remains fully exposed, preserving the ability to capture full price appreciation during market rallies and rebounds. So I want to showcase exactly how these first 4 funds have done. We have 2 winners and 2 losers, but the distribution rates are pretty crazy at nearly 30%. We have the NVIDIA fund at nearly 60% and the Tesla fund at nearly 108%, which is absolutely wild. But the proof is going to be in the returns, so let's take a look. I also want to showcase these funds are not nearly as popular as some of the competitors, YieldMax, Roundhill, and I think it's kind of interesting. So we have TSII at a $25 million AUM, MSII at under $5 million, and this isn't Rex's fault. This is because MSTR has been absolutely falling, and the dip in Bitcoin is hurting them significantly. Then we have COII at $6.4 million. Again, I'm kind of surprised this one's lower. It was severely outperforming all of the rest and then had a crazy pullback when Coinbase had a big drop on earnings. And then we have NVII, NVIDIA, their most popular weekly payer. And this one's at 55, almost $56 million in AUM. So the AUM is assets under management. It basically kind of shows a popularity index of the fund, but not when it comes to number of investors, just amount invested, if that makes sense. So you could have one guy put 20 million into NVII and you'd think, oh, everyone's buying this one. Not necessarily. But all these funds launched in June of 2025, NVII a little bit earlier. When we scroll down, we're looking at the price return. And my goodness, MSII. So because these do have a growth component to them, price is still a factor. And we can't just forget about it. Of course, the income is going to be beneficial as well. TSII is barely negative. MSII is negative 64%, which is wild. COII is down 36%, and NVII is up 8.6%. Now, Tesla was doing really well, has sold off a little bit since then, so NVIDIA is their best performer. But like I stated, COII was the top performer at one point. Now, I think that Coinbase will come back over time. We're seeing the crypto sector fall as a whole, so I'm not saying it's time to buy. This is not financial advice whatsoever, but these things go through a cycle. When we jump over and we change from price return to total return, we're going to see a different story. Now we have TSII up 26% on the year. MSII is still down 57, 58%. COII is down 21%, which is a bummer, but at one point it was up 49%. And this is when I was talking about it a lot because Coinbase was cooking, but it just got way too high. And then here is our bad earnings where it dropped by over 10%. But there also is a small kind of leverage component to this because they're targeting a 1.05 to 1.5 return using the options, kind of like a overexposure. But then we have NVII, which has been kind of going back and forth with TSII, but pulled out a little better with the last fall in the market, and it's currently up 32%. Now, it was up 52% in early November. So these last couple of weeks have taken a crazy toll on all of these. But one thing I still want to showcase is because they have more exposure and they're still generating income, I believe these to be a little bit of a safer asset as long as you believe in the underlying. And that's what I said. They have two big winners and two massive losers. None of this is Rex's fault. The strategy is working well, but you have to pick a good underlying. And if you're looking, maybe it's time to buy MSTR. Maybe it is because it's so beaten down, but you have to be careful with your selection. So we've seen some big winners, some big losers. Let's take a look at the new funds and see how their underlyings have been performing. Of the 5 new, most of these companies are pretty well known. PLTR, we've been talking about it all the time, and PLTR has a lot of other issuers that have funds on this. We have a YieldMax fund, we have a Roundhill fund, we also, I think there is a GraniteShares fund. It's pretty common. It's tech, it's AI, it's kind of defense, gets a lot of defense contracts for the US of A, and it's a large company, $370 billion. Walmart, even larger, $480 billion market cap. And I'd say everyone knows Walmart. I shop there. I'm not afraid to admit it. So why is there shame around shopping at Walmart where it's cheaper? I don't get that. I like Walmart. I've said it. I like Walmart. Then we have CRWV. This is one I didn't know as much about. Looked into it. It's info technology. It's AI. They have cloud-based services for when it comes to AI. It's a heavy AI company, which makes me a little bit nervous as we could see an AI pullback. And it is the smallest on the list at 35 billion market cap. Then we have LLY, Eli Lilly and Company, which is healthcare. And long-term, I don't usually like to invest in pharmaceutical companies. I don't like the idea of trying to make medicines, trying to cure diseases, and the risk that goes into that. I know some people like to trade them. I'm not a huge fan of it, but Eli and Lilly Company, LLY, they do target a lot of really popular diseases, diabetes, heart disease, things of that sort. And so they're working, and they do have some pretty large already in production medicines. So nothing terrible there. And then we have Robinhood, which I think is pretty solid. It's another one that everyone has an ETF out about it already. It's nothing new. But these other ones, Walmart, CoreWeave, and LLY, I don't know if there's any others that have these ones. I'm sure maybe there will be eventually, but in due time. I would imagine Roundhill would launch some like this because they launch a lot. And they do have some like on Berkshire Hathaway and whatnot. But it's interesting, and it's a pretty good mix. But again, it's going to come down to our underlying. So this is very, very important. And if you're going to buy any of these, I recommend doing some deep dive research into the underlying company. Go over the financial statements, see where they're making their money, see if they're in a bubble like with COII. I don't know if the AI bubble is going to pop anytime soon, but just double check. Now we're going to look at the price chart. So we can see some pretty phenomenal returns across the board. Walmart is our worst performer at 19%. Then we have LLY, which is up 41%, a consistent performer, but it was down at one point, down 15, 16%. Then jumping really high, we go all the way up to CRWV, which this one has fallen off steadily as well, which is not great. At one point, it was up 360%, and now it's still up 80%. Is this time, do we see the bubble pop? Are things pulling back? This is really interesting. There was some news about them with NVIDIA, and they're using NVIDIA chips and whatnot, which is tough depending on the company. It was from Jim Cramer, so I never really know how viable it is. But pretty good return overall, and definitely sold off pretty heavily. Then we have PLTR, that's up 152%. Again, defense contracts. I would like to say insider trading as well, because a lot of our Congress have been trading this one. And they are the ones deciding on who gets these defense contracts. So that's unfortunate. But I can't stand that. I can't stand our people that are supposed to be working for other people that are actually profiting on their positions. And I hope they ban trading for everyone in Congress all over. Anyways, just my opinion. Then we have Robinhood, which is up 206%. It was at one point up over 300% and has sold off a little bit. Now, there are some rumors about Robinhood actually making like a social media style app for investors. We already have that. It's called Blossom. And if you use my link down below, it's free. It's free across the board, even if you don't use my link. But if you want to follow me and see what I'm trading, check that out. It's a really cool app, and it's kind of like Instagram, but with all finance talk. So I am interested in seeing how these will perform, and I am going to continue to make content on these as we see their returns. Even if the market pulls back, I'll be tracking what weekly payers are paying out the most. So if you want to see that content, don't forget to like and subscribe, and I hope to see you in the next video.